Welcome to the webinar of ITM University Online. So today the topic of webinar is Anchor Investor. So you would have come across many type of investor like retail investor, institutional investors, the investors who get invest through the mutual funds. There are many types of investors. So what is this anchor investor? So anchor investors are the qualified institutional buyers, the QIBs. To whom the qualified institution placements are done during a public issue. And these are the investors to whom the issuers will allocate the stocks one day before the IPO. When a company go for an IPO, they will make allocations to the anchor investors a day before the public issue. And these anchor investors will come under a category called as qualified institutional buyers, to whom the qualified institutional placements will do. And these anchor investors are someone who have to make a minimum subscription of 10 crores worth of stocks. So allotment, when they are going for a public subscription, their subscription should not be less than 10 crores. It should be 10 crores or above 10 crores. And who are they? They are the qualified institutional buyers like the public finance institutions, which comes under section 272 of Companies Act 2013, like the Indian Railway Finance Corporation, Exim Export-Import Bank, SIDBI. So they are also an anchor investor. Then the foreign institutional investors who registered with SEBI as FIIs, they are also a qualified institutional buyer and they can also be an anchor investor. Then the mutual fund companies registered with SEBI can be an anchor investor, or the scheduled commercial bank, both private and the public banks, could be an anchor investor, and the insurance companies could be an anchor investor. Pension schemes could be an anchor investor. Then National Investment Fund could be an anchor investor. So what is this National Investment Fund? So National Investment Fund, they manage the funds which are accumulated through the disinvestments of the government companies. When a government company plans for a disinvestment, they will sell some stocks in the public. So for selling those stocks, they will get some money. Those money will be handed over to National Investment Fund and they will invest those money accordingly. Or when a government is selling something, some money is accumulated, that money will be handed over to National Investment Fund. They will act as a portfolio managers for the government. So they are also a good anchor investor. Then you have the insurance by Army, Navy and Air Force, by the defense. They are also an anchor investor. So venture capitals can be an anchor investor. Like this, these are the people. They are also called as qualified institutional buyers, and this qualified institutional buyers is an eligible anchor investor. So how this process happens? When a company go for an IPO, they decide the allocations. So how much to the public, how much to their preferential stockholders, how much to the anchor investors, they will decide. And they will inform these anchor investors, so we are going for a public issue and this is what the allotment we made for you. And the anchor investors will subscribe. As I told before, their subscription will not be less than or should not be less than 10 crores. So they will subscribe and their subscription will be accepted and the allocations will be made before, one day before the public offer. So they fix the price, because when you're going for IPO only, you will use the book building process to identify or to discover the price. But before that, you will fix a price and you will sell to the anchor investor. For example, I am going for an IPO where my floor price is 100 and the maximum price is 120. And here I am selling, or I am allocating the stocks to the anchor investors at my floor price. Say for example 100. 100 is my floor price. I am allocating for 100. So the day before all these allocations will be done, anchor investors will pay the money, and the money will be collected by the issuer, and it will be kept under his account, and allotment is done. But all this allotment will be locked in for 30 days. The anchor investors could not sell. They can't sell these stocks for the next 30 days. It will be locked in. And then the IPO will be done, book building will be done, and the prices will be discovered. For example, the prices is discovered at 110. To the anchor investor, the allotment is made for 100. So issuer is having a discount of 10 rupees. And that 10 rupees, the anchor investor have to pay. We're getting it. That anchor investors have paid only 100 rupees. Now the market has discovered a price of 110. 10 rupees is discount. That is not a discount to the anchor investor. The anchor investor have to pay the balance 10 rupees to the issuer to enjoy the benefits of stock holding. Then it is locked in for 30 days. Why it is locked in for 30 days is to avoid the competition in the issue. So as I told, the anchor investor, they are the qualified institutional buyers to whom the allotment is done by the issuer one day before the investor, or one day before the initial public offer. So here, if the anchor investor issue is made at a price discount to the IPO price, then the balance the anchor investors has to pay back to the issuer. And the scenario is different in the case of if the IPO price is lesser than the anchor investor's price. So what happens is, the allocation is made to the anchor investor a day before the issue, and then the very next day the issue is made to the public, and the book building process is done, and the price is discovered. Now the price discovered is less than the price to which the allotment is made to the anchor investor. In this case, the issuer will not pay back anything to the anchor investor. So that's a scenario here. For example, the anchor investor's allotment is made for 100 rupees. The issue is made to the public, and the public has accepted a price of 90. So the IPO price is 90. The anchor investor's price is 100. So anchor investors has paid 10 rupees more than the IPO price. So in that situations, the issuer will not pay back the 10 rupees to the anchor investors. But in the case where anchor investors have paid less than the IPO, then after the price discovery, the issuer have to receive the balance from the anchor investors. But in the case of discount, it is not happen. So that's the anchor investors. So here, what's the benefit of these anchor investors is, they could park a huge amount into an IPO, that too before the offer is made to the public. So they don't have the risk of going to the secondary market, hunting for stocks and buying in a huge. If they do that in the secondary market, they have to pay the brokerage, they have to manage all these things. So here, if it is done through the anchor investment process, all these qualified institutional buyers will be able to accumulate stocks at a very reasonable price and at a very reasonable method. So they can cut off all these intermediaries who comes in the normal primary market, and they could buy this from the issuers directly, that too a day before the issue. So now what is the advantage from the issuer's point of view is, they could market, they could easily sell their stocks to the group of anchor investors and accumulate money very safely. And if they lose their price in the discovery in the IPO, that means in the IPO they are discovering a price which could be discovered lesser than the anchor investors, and that risk is covered through sales to the anchor investors. So anchor investors is one of the best way for the issuers to accumulate money, and it is one of the best way for the investors to accumulate fund easily from the investors. And that's the anchor investors, and thanks for watching.